Hi, welcome to the CFO Squared podcast, chats about financial and financing optimization. I'm Karl Baker. This podcast is all about business funding, success, and strategy. We're here to help you know how to finance your business. We will also talk about other financial issues impacting your business and ideas to help you succeed and advance your cause. Now let's get into the next episode. Welcome, everybody, to episode 3 of CFO Squared. I'm Karl Baker, and today we're continuing our conversation on financial and financing matters. Today we're going to talk about some basic lending criteria. I'm going to give a couple stories. I get calls all the time, such as the following. Hey, do you do startup financing? Sure we do. What's your credit score? 500 to 600. Hey, can I get a loan for my business? We're losing tons of money, so we need a loan. Or how about this one? Hey, can you help me buy an investment property? Sure. What's your down payment? None. I don't have any down payment money. Or finally, hey, can you help me buy a restaurant? Sure thing. We sure can. What do you currently do for a living? I'm an IT technician. So those are all typical stories, and it may sound tough, but if you were a lender, would you lend to these scenarios? These are variations of real stories we get all the time. So today I want to talk about some basic lending concepts. We want to help you. We want to help position you for success and to help get started on the right foot. We want you to just to start to think like a lender and understand the lender's perspective. We at Infinity Commercial Capital and other lenders, but I'm here to talk about our firm. We can do all sorts of lending. We can do cash flow lending. We can do commercial and residential real estate lending, SBA lending for business expansion, acquisition, unsecured loans, borrowing-based lending for startups, factoring, PO financing, equipment financing. Really, though, we primarily focus on commercial real estate, working capital for existing and startups, and equipment financing. In that regard, though, and here's where we'll start to get into some of the content, all lenders evaluate a lending scenario based on some sort of version of the 4 C's. Those 4 C's are cash flow, credit, collateral, and what I call capacity of borrower. So let's go through. We're going to keep it relatively high level, but we're going to go through those 4 C's. The first C is cash flow. Cash flow does not mean revenues. When somebody says, what's your cash flow? They're not meaning your revenues. What they're actually meaning is your profit, revenues minus your expenses, the net funding available to run your business and to ultimately to pay your financing. Some call it funds available to pay financing. Another term is debt service coverage ratio. Lenders will evaluate your cash flow by looking at a number of things: your financial statements, your tax returns, and sometimes your bank statements. So in thinking about that, can you see some issues relating to those 3 reports? Tax returns show certain things. Financial statements are presented in different ways, whether it's, quote, accrual basis or cash basis. Bank statements show an altogether different, may tell an altogether different story. But ultimately, where I was going with that is some people, as running their business, they're focusing on doing it whatever they can to reduce their taxes. And so they throw as many things into their tax return as possible in order to reduce their taxes. That, though, will result in no cash flow reporting on the tax return. So one of the things that we do tell people sometimes when it relates to cash flow, you really can't have both. You can't show losses on your tax return and then expect to be able to convince a lender that your cash flow is high. I've actually heard some brokers even say, if you want to qualify for a loan, you better eliminate some of your deductions and show positive a taxable income on your next tax return in order to tell the story to a lender that you have positive cash flow. So that's a high level summary of cash flow. The second C is credit. When I say to you, what is your FICO score? What's your credit score? You tend to know what I mean by that. And that's your personal credit score. Well, there is a second concept called business credit, and some of the credit reporting bureaus report business credit. Dun & Bradstreet, and it's more than just, for example, it's more than just having a Dun & Bradstreet number. It's actually having a Dun & Bradstreet business credit profile. It's called the Paydex score. Certain companies, when you conduct business with them, will report that payment cycle and that payment activity to the Dun & Bradstreet Paydex score, credit score. Another one is the Experian Bureau. They will actually produce an Intella score, which is a credit reporting score. So those are a couple of examples. But relating to the FICO, what is the FICO telling you, or what more specifically, what is the FICO score telling a lender? In general, and there are a lot of details, and this is not meant to be a story on, or this is not meant to be an education specifically on credit scores. We could do that someday, but this is supposed to be high level. But the FICO score is telling a lender, in general, what are the chances that you will default in the next 24 months? And so a lot of data goes into the into your credit profile in order to help a lender gauge what those chances are. The higher the score, the conclusion drawn is the less likely a person will default on a loan in the next 24 months. The lower the score, the conclusion drawn is that it's more likely that a person will default in the next 24 months. Some of the components of the credit score include length of time, the history of your credit profile. How long have you had a credit profile? I tell people it's important to get that credit profile started as early as 18 or 19 years old and begin building that history. The amount of available unsecured debt is important. Utilization, in other words, in your personal credit profile, out of your total funds available in lines of credit and other debt, how much are you actually using? As a rule of thumb, we tell people if your and it's based on data, if your utilization is higher than 20%, then your credit score is going to be impacted. That means if you have, for example, if all you have on your credit profile is a $10,000 line of credit, if you carry a balance of more than $2,000, then it will start to negatively impact your credit score, all other things being equal. Other components of the credit report or the credit profile: debt to income. How much is your monthly debt payment compared to your monthly income? Finally, the types of credit, how much new credit you have, and what your payment history is. Those are a few things that go into the credit profile. So that's the second C, credit. The third C is collateral. These are assets such as physical homes or physical properties, known as real property, or personal equipment, such as equipment that are pledged as assets to be taken back if there is a default. Quite simply, the lender can take ownership upon default. The lenders are taking market risk, so they need their borrowers to take some of the risk. So what that means is typically if you have just to keep it simple, let's say you have $100 loan, the lender, and you want to pledge an asset for that, the lender is not going to give you $100 because of that market risk. And they need you to take certain component of the risk of that project. So they're going to give you a loan of $70 or $80, because again, the concept of skin in the game. Plus, it will help them be able to sell that asset at a discount as quickly as possible to get their money back if there happens to be a default. So that's a quick summary of collateral. The third, and most people are familiar with that. The fourth component, the fourth C, is a phrase I coined and called capacity of borrower. And it's just a general phrase. It depends on the type of loan, but there are some intangibles, and it's things like, what are your personal reserves? What's your experience? What is included on your personal financial statements? How much you own, how much you owe, etc. That's the fourth C. So those are the four C's that we talk about: cash flow, credit, collateral, and capacity of borrower. And like I said, all lenders look at some portion of these loans, of these C's, in order to evaluate a loan scenario. They're all weighted differently, though. For example, some real estate lenders put very little into cash flow. Sometimes they don't care. These are called hard money lenders. In certain scenarios, hard money lenders really are not looking at cash flow. They're certainly not looking at the capacity of borrower. They purely loan on collateral. And that sounds great. That sounds easy enough, but that also means that the rate will not be probably the lowest rate available. However, funding will happen quickly. Another example, factoring. Accounts receivable factoring is a scenario where you are financing your accounts receivable, your outstanding charges from customers, and you're selling those outstanding charges to a lender. They will accelerate the receipt of those payments. Those financiers don't actually care about your credit, because when the lender gives you the advance on that factor, they don't care about your credit. They care about the credit of the customer that will ultimately pay them for those outstanding charges. So perhaps let's say, for example, you need fast working capital, but you have a bankruptcy in the last 6 months. You're probably going to have a hard time getting funding from a banker. However, factoring is a situation that will work for your scenario. They don't care about your credit issue. They care about your customer's credit. And if you have a quality business and quality customers that have good credit history, factoring will be a solution for you. So that's an example where credit is weighted differently and is looked at differently. Working capital lenders don't care about collateral by and large. There are certain collateral-based working capital lenders out there, but in many cases, if there are lenders out there that will loan based on cash flow. So they're really looking at your cash flow. They'll look at your credit, but they're not looking at collateral, as an example. Finally, another example is how do startup businesses obtain funding, and how the 4 C's apply to evaluating financing for a startup. Well, there's really lots of ways that startups obtain funds, but I'm going to talk about 2. The SBA, the Small Business Administration, they will support startups by providing SBA guaranteed loans through banks. They really look at all 4 C's, and certainly they'll slightly look at them differently, but pretty much all 4 C's are looked at pretty thoroughly for an SBA loan. The other scenario that I think of when I think of startup financing is unsecured line of credit financing. That's credit card financing. It's at least how that starts. And credit and income, i.e. cash flow. Those are 2 gateways that really help a business owner begin to obtain financing. So collateral, not as much. Capacity of borrower, not as much. Credit, income, and income are 2 major factors. So that's a very high level summary of the 4 C's. And why do I explain those? Why is it important to understand that? I personally think that it helps you as a potential borrower understand how lenders think. When I actually got into this business, I had questions running through my mind as I was ramping up my training. I wanted to understand how lenders think. I wanted to get into the minds of a lender, beginning to understand these 4 C's. And this is a very high level conversation, no doubt. But beginning to understand those 4 C's really helps you to begin to understand the expectations of a lender and understand how they're looking at your financial deal. If you're better educated, you'll know how to prepare. You'll know how to target. You'll know what to expect as you begin to seek financing. We get lots of inquiries, things like, hey, we need a loan. I need an SBA loan because I read about them somewhere. But many times the requested loan may not be the right loan for the particular scenario. So again, understanding these 4 C's as a starting point will help the process go better for you as the borrower. Plus, sometimes it helps to understand the problems that you're going to have going into a financing situation. And I would just ask or suggest that understanding these 4 C's will help you to know what to do and how to pivot if you find yourself outside of a lender's criteria, a lender's set of parameters for qualifying for a loan. It will help you to reset your expectations. I think it's good for borrowers to be coachable so that they can understand what they can qualify for and know how we can go for those types of financings instead of the one that you are initially seeking. You know, if I'm a borrower and I say I want to buy so-and-so property, but I know I can't qualify for that property, it's good to understand how those financings are evaluated. And it's good to understand how to use that information to be able to put together a financing scenario that I would qualify for. So I think that's important. I'm going to end with another story. A customer called me recently looking for working capital. They had good credit. They had solid cash flow, and they were coachable. They asked me for a loan. Hey, Karl, I need to buy some equipment need to buy some supplies for my manufacturing business. They asked me for a loan, but they also said, what's your opinion? What's the right solution here? And after studying the details more, after evaluating the scenario with some information that he sent to me, I determined a loan, meaning a term loan, 5, 7, 10-year term loan with a principal and interest payment over a number of years, wasn't really the right solution. That person needed a unsecured line of credit solution that would be a more permanent financing as they go through the ebb and flow of their business's various seasons, selling cycles. So we entered into this working capital solution. It was very quick, very worth the time, money, and effort. And it helped the client get the year off to a good start. That client actually called me recently looking for more solutions, and we've steered him in the right direction. And I believe that it was based on a good understanding of these 4 C's, a good understanding of determining the right financing path for that client, and understanding some of these lending fundamentals was important. I hope it helps you. It helped that client. I hope it helps you. And we'll end with that, and we'll talk to you another day. Thanks a lot. Bye-bye. this concludes the latest episode of CFO Squared, chats about financial and financing optimization with Karl Baker. We hope you enjoyed the episode. Leave us some notes or comments or questions by reaching out to us via email or phone number. Our contact information is in the show notes, and we would be glad to try to answer questions, take your notes, questions, and comments into consideration for future episodes. Until next time, signing off. Thanks again. Bye-bye.